Apple reported third quarter results today, which were largely in line with market expectations. However, the guidance fell short of the consensus estimates, and as a result, shares fell up by about 7% in after hours. In this video, we're going to take a look at that 7% price decline and determine whether or not it makes sense based on the guidance that the company gave. To do that, we're going to use our earnings model. So on the left is the press release, and we've gone through the press release and updated our model to include the latest details for all of the financial statements. And we've also included management's guidance for next quarter. And we're going to compare that to our prior version, which we published just before the company reported results. If you're new to our models, they basically follow the same format throughout all the different companies. You can see in the upper left-hand corner is our color code, which tells you anywhere that you see a blue cell that represents our Gutenberg estimates. Purple cells represent management guidance, and orange cells represent consensus estimates among analysts. The top section is the income statement, which is built based on details in the segment data. So you can see here we have average selling price for iPhones, iPads, Macintosh computers, iWatches, and growth rates which drive the unit sales, and all of this detail filters up into the income statement. So it's what's driving these values here. Below, we also model a full balance sheet and cash flow statement for advanced users, which are really used in the discounted cash flow valuation. If that's a bit too tricky for you, then you can just use the straight multiple valuation here. And our total valuation up top, the 50-50 approach that we're using, is based 50% on the DCF and 50% on the market multiple. So you can see prior to the release, when the earnings model was calibrated based on consensus estimates, the share valuation was $150. So now, with all the new estimates, it's down to $142. So that's just over 5% decline from our expectations prior to the release. So maybe the 7% decline is a bit much. Tomorrow might be a good buying opportunity. Wouldn't be surprised if a lot of that value comes back. So where did the company miss? Within the model, you can see a breakdown of the earnings. So this represents the fiscal third quarter actual or consensus estimates. All the orange are consensus estimates prior to the release, and then here's the actual numbers, and you can see that on just about every metric, revenue, gross margin, operating margin, and EPS, they beat. But then if you look at where they guided to, all of these purple cells, they missed in just about every metric. So revenue is light. Gross margin, so estimating that they'd be a little bit more profitable, but operating margin is lower. Even the tax rate was slightly higher than what the consensus estimate thought. And then if you keep the share valuation constant from the 3Q actual, the EPS would be 179. Obviously, the share count would change a little bit, but all things equal, you get $1.79 of EPS versus the estimate of 186. So guidance did disappoint to some extent. That could be a function of a number of things. iPads continue to be weak, but that's pretty much expected. The iWatch, the street was expecting somewhere around 3.5 million watches. The company didn't disclose how many they actually sold, but you can sort of back into that number. If you hold accessories constant, well, actually in our case, we showed a growth rate of about 5% for accessories and said that the remaining other category was revenue from the iWatches. And if you estimate approximately $400 per watch, that means they would have sold somewhere around just over 2 million. So definitely light relative to what the consensus estimate was, but it's not a meaningful amount of revenue. So it might just be a little bit more telling about the ramp of the product. So maybe that's calling into question a little bit of what next year's earnings might look like based on the success of the watch. So that could be one thing. And then the other thing is the cash balance did increase, but if you think about how cash affects the valuation, We have that in our market multiple valuation if you scroll down to the bottom of the model. So we do a next 12-month PE ratio excluding cash, and then we add the cash back in after making an adjustment because a large portion of the balance sits overseas, and if they repatriate those funds back to the United States, they're going to have to pay taxes on it. So we do a rough estimate of how much that would be. What this equation is basically showing is that 89% of the cash is offshore based on today's report. And if you take that 89% and back out at the effective tax rate of just over 26%, their adjusted net cash per share is $20.66. So prior to this release, the off-balance sheet cash balance was about 84%. So watch what happens when we change this to 84. Price falls by about $1. Oh, whoops. This goes to 84, and then the remaining is onshore, so the price increases by $1. So the fact that a larger portion of the balance is sitting offshore meant about $1 of value decline after this quarter. So the price move probably makes a bit of sense, but it might be a little steep if it's 7 or 8%. So I think the company will most likely get a good amount of that back tomorrow. Alright, if you'd like to download this model, please visit our website, www.gutenbergequityresearch.com. If you click on the Models and Focus section, you can see a detailed analysis for how the model works. And you can also purchase it for just $5 in our model store, if you click here. And be sure to check back later in the week after the analysts update their estimates, and we'll update the model to recalibrate based on that consensus. Thanks for watching.